Welcome back to the channel, guys. I wanted to do a video around specifically zero DTEs. There's been a lot of skepticism around the ones that have come out from income shares, but I just wanted to give an overview of the zero DTEs, what they're about, just so that people get an understanding. What does zero DTE mean? Zero DTE stands for 0 days to expiry. These options contracts, they expire on the very same day they're traded. So they're compressing that entire life cycle from creation to worthlessness or settlement into a single trading session or trading day in effect. The market's transformed, so about 50% or just over 50% of all of the S&P 500 or SPX options trading volume is now in contracts that expire the very same day. This shift is from long-term investing to high-frequency intraday trading, representing one of the more significant changes in the market dynamics within probably the last decade. And just to illustrate this, while it was technically possible to trade zero DT options on Fridays after 2025, the modern high-frequency zero DT market was truly born in about 2022. So this is when exchanges completed the calendar, making expirations available for every day of the trading week, and it ignited this explosion in volume. So we had this pre-2005, I've labeled it old guard, sort of monthly options where the standard offerings were only 12 expiration days per year. Then we had in 2005, we had the weekly options arrive, where you got weekly options which create a zero DT opportunity every Friday. And then in 2022, the daily market is born, where we've now got Tuesday and Thursday expirations which were added, making zero DTs available for every day of the trading week in effect. And we can see here in this chart below, which shows the percentage of the total S&P 500 options that is zero DT. Note the sort of dramatic inflection point in 2022 when daily expirations became available. Okay, we can see that steep curvature upwards, and it's continuing in that upward trend, although it's starting to probably plateau a little bit now. Okay, so I talk about the gamble. So what is the gamble? There's obviously the allure of the high-speed gains. So the primary appeal of a zero DT option is leverage. A small, unexpected market swing can cause the value of an option to multiply exponentially within minutes, creating the potential for massive returns. And this is the thing that people don't appreciate, that as soon as you open the option, the decay is so aggressive, the time decay, the theta is brutally aggressive on expiration day, often causing an option's value to literally evaporate to zero. And so when we look at this, obviously there is a lot to lose and the gain is quite hard to achieve. And so this is something that people need to be really mindful of with these zero DTE options. In terms of the playing space, so who's at the trading table right now? A significant portion of the volume is driven by retail traders, actually, drawn by the lower premiums and the potential for quick profits, especially in the short-dated options. So if we look at the less than 5 days per expiration, we're looking at 56% being retail investors and 44% being institutional traders. When we look at the greater than sort of 30 days, so monthly plus options, we see the spin is 66 institutional traders and 34% is retail traders. So we can see how the shift has occurred, and we probably will see an increase in institutional traders starting to come through with these funds and these ETFs, which we'll talk about in a second. And likewise, when we look at the kind of real world returns, analysis of retail accounts from 2022 to 24 consistently shows the losses are more frequent and larger than wins. This is due to that accelerated time decay, that theta decay, and the need for significant, correctly timed price movements or high gamma, creating a difficult headwind for directional buyers. And we can actually see the average win rate is 45% and the average loss rate is 55%. But more importantly, the average loss per trade is substantially more, right? It's $280 versus $110. So we can really see the risks with these zero DTEs in particular. Now, if we were to look at this from an ETF perspective, so the zero DTF sort of trading upside for income. So a key distinction for these kind of funds is yield versus total return. So while they often advertise these high annual yields from collecting daily premiums, this is not the same as an investor's net profit. Okay, the actual total net return is significantly lower after accounting for the management fees and periodic losses that can wipe out many days of gains. A more realistic target net return for a typical year might be closer to kind of 8%. So if we look at this from an annual return profile, 0DT ETF versus an S&P 500 index, the S&P 500 historical average is around 12%, a 0DT ETF target might be 8%, and a crash scenario might be around negative 15%. Remember that these will typically do slightly better than the market in a downward trend because you're offsetting some of that with the premiums, but the 0DTs are so aggressive that may not even happen. Okay, looking at a real world case study here, I picked a really popular fund, which any of you who follow the US markets will have heard of, XDTE and QDTE, which famously at one point was even outperforming the underlying. Now, this data is taken from totalrealturns.com from March the 7th, 2024, which is when the inception of these funds were, up to September the 19th, 2025. Okay, historical index averages are the long term. So I've broken it down into the two core ones, which is the S&P 500 and the NASDAQ. So XDT is a new fund with a limited track record, about a year and a half. So while its annualized returns during a strong market has been impressive, and we've had a really good market, it still lagged a simple buy and hold strategy, demonstrating the capped upside trade-off. So we can see XDT did 16.55%. The S&P 500 in the same period has done 19.43%. And the historical average of the S&P, as we talked about earlier, is about 12%. And if we look at now QDT, the NASDAQ, kind of applying the same strategy, but to the NASDAQ now, also shown strong performance, but again underperforms its benchmark, reinforcing that capping gains for income in the core feature of the strategy. So again, QDT done very well. Everyone will be happy with a 20% return. NASDAQ's done 22, almost 23%, and the NASDAQ historically has done 16%. So we can see how these funds can do very well despite the aggressive nature of the time decay. It can do pretty close to the overall markets in their respective indexes, but again, they're still unlikely over a long period of time, and this is the important thing, over a long period of time, likely to underperform the overall market. But again, this is about income, so we're not there for the growth side of things, but it's important for people to understand this. So just in summary and conclusion then, the bottom line is a tool for pros, a trap for many. Zero DT options are powerful, they're high leverage instruments, they're not loss through tickets. Whether you're buying them directly for directional bets or investing in an ETF that sells them for income, understanding the extreme risk reward profile is critical. Okay, directional buying offers explosive gains, but you face a strong house edge due to that time decay, theta decay element. Zero DTs offers automated income, but again caps the upside, charges high fees, and retains significant risk in a market crash. So success in either arena requires a deep understanding of options, Greeks, disciplined risk management, and a robust strategy. Again, this is just information for education purposes only. Don't treat anything I've told you as financial advice. Options trading involves substantial risk, and it's not suitable for all investors. But there you go, guys. I thought I would do a video around zero DT so people get a little bit of a better understanding around them and the potential risks and rewards around them. Hopefully you found this one useful. I will catch you on the next one.